last lecture, we had a really awesome discussion with perfect questions. We spent a lot of time discussing the issues, which was absolutely perfect and the best thing to do. But unfortunately, this made us not this course that we didn't finish the in-class example. In order to correct this, I've decided to make this video where I will pick up where we left off at uh, at the lecture. So you can see where we left off. We've noted down the basic terms of the bond that we found in the text assignment. This was the nominal value of the bond, the coupon rate, the coupon periods, maturity, market rate, which is the rate of return or yield that the investors will require on the market. We've calculated what will be the expected proceeds of the issuance of the bonds, or in other words, how much money are we going to get when we issue the bonds. We've calculated this present value as present value of two streams of cash flows that are on the bond. First one was the nominal amount, the second stream of cash flow were the coupon payments, and we've determined that this value is 932,672.55 euros. So as we see, the proceeds that we can expect from issuance of the bonds are lower than 1 million, than its nominal value. This means that the bond is issued at a discount, and this makes perfect sense because, as we know from the beginning, the coupon rate or the rate of coupon or interest generated by this bond is lower than the rate that the investors are expecting to get or requiring. That's why they will require to get additional yield or additional return that will be represented by discount on the nominal value of the bond. So that's what we did. Then we made the first accounting entry at T0 at the point of time where when the bond is issued. So this entry was difficult for some maybe, but actually it's pretty simple. And the reason why we are working with this accounting entry is to demonstrate actually how interest expense on the bond works. And interest expense when compared to coupon payments is the best mechanics how to understand the difference between coupon rate of the bond, the effective rate or the market rate of the bond, and why bonds are issued at discount and what is the actual cost of borrowing. So back to the accounting entry at T0. So we've determined that actually we are in this point we are getting cash. As we know, the first account, if cash is involved, we are dealing with cash first. So we know that we are getting cash. We are getting the proceeds of the bond, which we calculated as 932,672.55 euros. So this is the cash we are getting. Cash is an asset, so it increases with debits. So we debited cash. Then we know that we will have an obligation or a liability to repay the nominal value of the bond at maturity. So we need to record this liability. A bonds payable is a liability. Liabilities increase with credits, and so we enter the nominal value, which is the amount we owe that we need to repay at maturity, and the accounting entry needs to reflect that. And then we've also reflected the bond discount, which we calculated as the difference between the proceeds we are getting from the bond and the nominal value of the bond. And we know that bond discount is a counter liability. Counter liabilities increase with debits, and we can see that our accounting equation holds. We've also created a table that we will use for various purposes. The table in first column lists the coupon periods that we have. Then we know that during each coupon period we are obliged to pay the coupon. Coupon is extremely simple in this case, given that the bond is repaid, has a bullet repayment. It is the whole nominal amount is repaid in as a whole lump sum at maturity. It means that the basis for calculation of the coupon doesn't change. It's still 1 million. We know that the coupon rate is 6%. We know that we have 6% per annum, and we know that we have 2 coupon periods in each year. So in relation to each coupon period, it's 3%. 3% out of 1 million is 30,000. Simple stuff. We use this the calculation of coupon also for the purposes of calculation the present values of these coupon payments. And then the next column is when things get interesting, because you can see that we have interest expense there. And during the class, we've managed to calculate this interest expense, and we've determined that this interest expense is calculated not using the coupon rate and the nominal value, but using the market rate, or the rate of return that the investors are requesting, the minimum value of return that will make the investors to buy our bonds, and the carrying value of the bond, or in the case of the first entry is actually the present value of the bond. So just let's put these two into perspective. The coupon payment is simply a function of the nominal value of the bond and the coupon rate applicable to a coupon period. And interest expense is a function of the proceeds of the bond, or the carrying value of the bond, and the market rate, not the coupon rate, the market rate. And now let's see what happens then. We see we have a discount balance. This is firstly the discount that we've calculated as on the bond, simply as a difference between the nominal value of the bond and its present value, or the proceeds of the bond. But we see that this discount will be slowly amortized. It will need to get it off our balance sheet, and the procedure how we will achieve this, that we will always take a look at the difference between the interest payment and the coupon payment. And this amount is crucial, because this amount will be slowly transferred from the discount balance into the carrying value of the bond. So during the first interest period, we need to pay in cash 30,000 euros. We incur interest expense 37,000 euros. We can see that the interest expense is higher than the cash outflow, which makes sense because the bond is issued at a discount, meaning that the market rate is above the coupon rate. And we know that the interest expense is calculated using market rate, not the coupon rate. And now we see that the difference between the interest expense and the coupon payment will slowly decrease our discount balance. So we'll just put it here. And the second part of the story is that the discount will be slowly removed, or the difference between the interest expense and the coupon will be slowly removed from the discount balance, and it will be slowly transferred into the carrying value of the bond. What is important, what you've maybe already see, that the carrying value will be increasing. As we will see, eventually it will reach the nominal value of the bond. And we know that interest expense is actually a function of the market rate and the carrying value. And we can see that the basis of this function is increasing, so it follows that the interest expense will be increasing. So we'll just, I think everything is set. We'll just finish the equations. And we can see that everything balances out pretty nicely. And just to sum it up, what we've just done, we have the discount balance. We slowly amortize or reduce the discount balance by the difference between the interest expense and the coupon payment. And this difference between the interest payment and coupon payment is slowly transferred from the discount balance to the carrying value of the bond. Given that the carrying value of the bond is increasing, and the carrying value is the basis for calculation of interest expense, the interest expense itself is slowly increasing. Eventually, in the last coupon period, the discount balance will be reduced to zero, so it will be completely written off, and the carrying value of the bond will be equal to its nominal value. This is important takeaway. And the last thing that the tax example requires us to do is to make the accounting journal entry at T1. It means in this point of time at coupon period, at the end of coupon period 1. And this is the reason for this is again to finally demonstrate the difference between the cash outflow and interest expense, and by extension to demonstrate the difference between the coupon rate and the market rate. So again, the first question we will ask ourselves is whether cash is affected or not. We know that cash is affected because we actually need to pay in cash, the coupon payment in cash, right? No matter what the interest expense is, we need to pay the coupon, the 30,000 in cash. Cash is an asset, so it is reduced by credits. We know that our cash is reduced because we are paying this cash out to our investors as a coupon payment, so we will put it into credits. Then what other account is affected? We know that we actually incur interest expense, right? So we have interest expense, and we know that this interest expense is equal to this amount. We know that interest expense is an expense. Expenses increase with debits. So we enter it there, and then actually the actual entry would be a little complicated. We'll simplify it for our purposes, but the third account is the amortized discount balance. We know that this is actually the amount that by which we decrease the bond discount. We know that the bond discount is a contra liability, and this is the amount that reduces counter liability. So it is an amount that increases with credits, right? We know that contra liabilities increase with debits. This is a contra liability in a sense, so it increases with credits. I know it sounds crazy, but it's not that complicated. We know this is actually the portion of the discount being amortized, and now we see that the equation, the accounting equation holds once again. So that's basically it. Have a good evening and take care. Bye.